Hello, everybody. Welcome to another episode of the Olympus Wealth Strategies Podcast. I'm your guest, John Sidery, where we help you take your finances to great heights. And I am very thankful to have two special guests with us. This is probably the most requested topic episode that we've ever had, Social Security. And the guest that I've got with us, very thankful to have. I've got Jim Blair, who is worked formerly at the Social Security office, and Marc, who ultimately is a retired CPA, but ultimately both of them together have their business, Premier Social Security Consulting, in which they help advisors across the country really understand and the intricacies and all the different planning that gets involved in Social Security, which is a very big decision for people approaching that age and lifestyle. So Jim and Marc, thank you so much for joining, taking time. And if you guys wanted to maybe give a little bit more of your background.
Thank you, John. Definitely would be happy to. Marc here. Firm, like John said, is Premier Social Security Consulting. Jim and I are both based out of Cincinnati, Ohio. I got into the Social Security space when I met Jim Blair back in 2010. At that time, we did consultation for folks across the country. And then in 2013, we evolved into an education company when we created the National Social Security Advisor Certificate Program. I don't do taxes anymore. That's 30 years of my life, which I just want to forget about. I focus 100% of my time, John, in the Social Security space. Jim?
Yeah, I worked for the Social Security Administration for 35 years. Listen to what my mom told me. You should always listen to your mom, correct? She said, get a government job. So I did. And I worked for the Social Security Administration and did a number of jobs. Started off as a service representative. That's that smiling face you see when you walk in the front door. And they generally help folks who've already applied for benefits. Maybe they're missing a check, they're overpaid, underpaid, address issues, all sorts of things that we took care of. Moved into the claims taking part of it, though. Took claims for retirement, survivors, disability, and health insurance. Did that for 10 years. Moved into the management end of it, did a number of jobs, but spent the last 9 years as the district manager of the Piqua, Ohio office. Now, Piqua is a nice little rural community about 30 miles north of Dayton, Ohio. And what that points out for you is that wherever you are, there's a Social Security office fairly close. Probably the most accessible government office out there. It's becoming a little less accessible, maybe, with some of the rules changes, but it's still the biggest one that has field offices out there.
Well, I'm really thankful for both of you, obviously, coming on because your backgrounds really fit exactly what I would say most clients ask us and start to engage us on is, their Social Security benefits and how that fits into their larger retirement and financial plan. So let me ask some of these questions that came in. For someone nearing retirement, what is the very first thing they should understand about Social Security benefits?
First thing they should understand is that they need to go to the Social Security website, ssa.gov or socialsecurity.gov. Make sure they've created their online account. This way they can view their statement as often as they need to. The statement is a very good tool in starting your journey relating to Social Security. It will show you your benefit estimates at ages between 62 and age 70. And it will also give you the earnings that are posted to your record that are used to compute your Social Security benefits. So they need to have an online account so they can review their statement and get an idea what's going on. What do you think, Jim?
Yeah, I agree. In fact, people should create that online account as young as age 18. Even the young folks should do that. But go ahead and create your online account so you can look at this benefit statement ahead of time. Also, make sure the earnings that are posted to your record are correct that Marc was talking about, because that is what they use to determine that benefit amount you're going to receive at 62, full retirement age, or 70, or whenever you decide to begin those benefits. So it's real important for you to create this account.
And so that was one of the questions was, figuring out how much their benefit will actually be. It sounds like one of those places and tools that you all would say is a good representation is that creating that online portal, going in and entering your information, verifying your earnings were correct. But it sounds like that Social Security benefit calculator that they provide through your SSA.gov account is pretty accurate.
Yeah, it's based off of your actual earnings. So what you want to make sure is what's posted on there is correct. And then that is going to be what your benefit will be. Of course, what they do is the further you are away from age 62, maybe it's not exact because they do project earnings. So for instance, we're in 2025. They will project what someone earned in 2024 up until age 62, 63, all the way to 70. But it'll still give you a good amount of information there and a pretty close accurate. The closer you are to 62, the more accurate it is. But, it's a great planning tool.
Perfect. Well, here's I think probably the most asked question for you all. And I'll preface it with, when people ask me this, I ask, well, how long are you going to live? And I'll tell you when to file. But what are the pros and cons, Marc and Jim, of filing early at 62, maybe versus delaying up until age 70?
Well, of course, the biggest benefit of filing at 62 is what? You get a check. You get paid.
That's right.
You receive your Social Security benefit every month for the rest of your life. Of course, the biggest negative is it's reduced for age. So if somebody's full retirement age is 67, and most people's would be at this time, and they file at 62, John, they'll take a 30% reduction in their Social Security benefit. And that reduction lasts for the rest of their life. And if somebody's going to claim off them when they're gone, that benefit would be reduced too for the rest of their life also. But we were talking about the Social Security benefit statement. I just want to make one quick comment. I don't want anyone to believe that, if you've got a spouse out there, that your decisions could be based on what your benefit statement shows. Social Security is like a family unit type of benefit. Family unit will usually be husband and wife. Maybe you need to factor in some young kids. Maybe somebody might have been maybe there's a deceased spouse out there that might come into play. So looking at your statement is maybe the beginning, but always take into account everyone else that's in your family to determine the best options available for your family unit. Now, Jim, why don't you talk about what are the benefits of waiting maybe till all the way up to age 70, which 95% of folks do anyways, right, Jim?
Yeah, 95% of the folks do not wait until age 70, but somewhere between 5 to 7. But, a lot of people do. Waiting will increase your benefit amount. Now, if you want to take benefits at 62 and still work, then you can lose some of your benefits to what's called the annual earnings test. Once you reach full retirement age, the earnings test no longer applies. And regardless of what you work and earn, you can still draw your Social Security benefit without it being offset any at all. So it's going to give you a higher benefit. People are living longer. Your break-even point of 62 versus full retirement age, it's about 12 years. So you're looking at somewhere close to age, say 79. You've received the same amount of money, whether you file at 62 or full retirement age. And according to the Social Security Administration anyway, a male in his 60s has an average life expectancy of around 84 and a few months. A female around age 87. They also tell us that half of the people in their 60s will live to their upper 80s, early 90s. A quarter of the folks will live to 95 or older. What they don't do, they don't tell us who that is. So, we kind of got to figure that out on our own. But as Marc mentioned, it's also can be a joint lifetime benefit. Once you take your benefit, if you take a reduced benefit, it's always reduced for the rest of your life. If your spouse steps into your shoes when you pass away, if you took a benefit reduced, they'll receive a reduced survivor benefit. So it's, it depends on how important the survivor benefit is in your estate planning. If Social Security is a big part of it, you might want to wait as long as possible. Does everybody wait till 70? That certainly gets you the highest amount of money. Your break-even point there is about age 82. Yeah, so a lot of people don't want to wait that long, but full retirement age definitely gets you more money than age 62.
Yeah, and I think that's a really good point, right? It's really taking a holistic view, understanding how dependent is that family unit on their Social Security benefits relative to some other factors like you all had mentioned, right? Life expectancy and cash flow planning, and ultimately trying to marry what seems best between. I think Marc, you said a few moments ago, hey, the biggest benefit filing at 62 is you get that check today. And I think a lot of families that we talk to are kind of in that balancing act of trying to understand, based on family history, how long do they think they might have a chance of living? What does that life look like maybe in the last several years, and balancing the cash flow between, do I really need this Social Security today, or can I defer? Or if I want it today, is that going to help me maybe achieve the dreams of, traveling more or giving some to my grandkids or doing whatever? So it's definitely not a one size fits all answer, is it?
Well, John, one common strategy for married couples is, let's just assume for now the wife is the lower earner, husband's the higher earner. It's for the wife to take her benefit at age 62. That brings some cash into the family unit. That might allow the husband to wait until his full retirement age, or as late as age 70, to take his benefit. And I was going to say something else. That right there is the decent strategy for the wife to take her benefit early, and for the husband to wait until his full retirement age or age 70. Of course, though, by her taking her benefit early, you do have another complication. Got the earnings test. So if she's making more than the earnings test amount, Jim, that's what, 23,000 or so?
23,400 this year, probably go up a little bit next year. But if you go over that amount, then you're subject to the earnings test.
So if she's going to make over that, then some of her benefits may be withheld. Oh, I know what I was going to say. By she takes her benefit early, and then upon the death of her husband, she'll step into his shoes anyways and collect as a surviving spouse. So she'll be able to collect 100% of what he was receiving or eligible to receive at death, as long as she's at her full retirement age.
Well, guys, you just mentioned something, and this was a question that had come in quite a bit, is that earnings test and how it plays into account if someone files, exactly like you just mentioned, Marc, one of the spouses files early and one of the other spouses maybe waits for a later date. That earnings test, though, is that based upon, let's assume now they're married filing jointly. Is that earnings test looked at solely that individual, and if they had income and how much income they had, or is it looked at as a family unit on their tax return? How does that break down?
Yeah, it's an individual amount. So it's based on the earnings of the person that's actually taking the benefits. If you and your spouse are working and you file for Social Security, doesn't matter what your spouse earns. It won't affect your Social Security benefit. It's only what you earn. And it's just earned income. It's not pensions you receive from an employer. There's not a whole lot of those around anymore, or your draws on your 401ks, IRAs, that type of thing. It's just earned income. So if you receive a W-2 for work, or if you're self-employed, it's your net profit is what they're looking at. But it is an individual earnings test that they're looking at.
And John, we get that question all the time. And so many people confuse the earnings test with something else that's not very exciting. Taxation of benefits. There's no doubt about it. You can be paying tax on up to either 50% of your benefits or 85% of your benefits, depending on what your level of income is. And more people pay taxes on their benefits. And that's on a joint basis. Yep. Jim talked about the earnings test. That's on the individual basis. Taxation, if you file a joint tax return, it's based on your joint income. So, and the threshold.
What trips people up the most, would you say that, I think they believe since it's the earnings test is just looked at themselves.
Yeah.
I think they get surprised when they start seeing whether it be their Part B premiums or their taxation, knowing, oh wow, this is looked at as a unit, even though the earnings test, as far as how much I'm going to receive on that monthly payment, was just looked at for myself.
And more people will be paying tax on their benefit with each passing year. And that's because the thresholds to determine if you have to pay tax on your benefits are not indexed for inflation. So the thresholds were set at either $25,000 or $35,000. I don't. 25,000, let's just say that, back in 1983 by President Reagan, and it has not been indexed for inflation. So you can see that more with inflation at right now about the 3% range. And in the past, it's been greater than that. Back in the early 80s, inflation was at almost 20%. So more and more people will be paying tax on their benefits because the thresholds are not indexed for inflation. We need to write Congress. We need to get that changed.
Yeah. I mean, especially, 25,000 is considered poverty level. And so that's, there's not much room there.
It's like only being able to write off $3,000 in extra capital losses. $3,000. That's all we get in 2025. That should be $10,000 if you ask me, Yeah,
you would hope out of a 1,000-page tax bill, we could get some extra benefits in there. Maybe the next bill. So can you all, this is a pretty hot question for several people we work for. Can you walk us through how spousal benefits work, and maybe how those differ from survivor benefits?
Yeah, big difference. Of course, we know the biggest difference between spouse and survivor benefits, but the benefit you receive is different. The rules are different. So with spousal benefits, the lower earner can be eligible at their full retirement age for 50% of the higher earner's full retirement age benefit amount. So if the higher earner has a full retirement age benefit of $2,500, then the spouse can be eligible for a spousal benefit of $1,250. Now, if the spouse is eligible on their own work record, that's deducted from that. So in this example, the higher earner is eligible for $2,500 at their full retirement age, and the lower earner is eligible for $1,000 at their full retirement age. When they file for benefits, if they're full retirement age, they'll get $1,000 from their own work record and $250 from their spouse's record to equal the $1,250. Half of that person's, the higher earner's benefit. But if, say, they're eligible for $1,500 on their own, then they're just going to draw on their own. There would be no spousal benefit payable in that situation. So it's always going to be looked at, what are you eligible for on your own work record first, and then is there a spousal boost payable on top of that? One of the questions we do get asked is if the spouse never worked, are they still eligible for a benefit? And the answer is yes. In that case, in our example, the spouse will get $1,250 in spousal benefits at their full retirement age. They can take those benefits as early as age 62, but just like retirement benefits, they're reduced for age. And if your full retirement age is 67, the spousal benefit is actually reduced 35%. At age 62. So you want to factor all that in versus, say, the survivor benefit. A survivor benefit is based on 100% of what the deceased was receiving or would have been eligible to receive when they passed away. So if our person with the $2,500 passed away, then the surviving spouse at their full retirement age would be eligible for $2,500. And if they're eligible on their own, if they're not already receiving it, they don't necessarily have to take their own first. They've got some options. So, for instance, you could take a survivor benefit as early as age 60. And then if your own's going to be higher, you could wait and switch to that at 62, full retirement age, even wait till age 70. In the meantime, you're drawing off of your deceased spouse. Then you switch and get a higher benefit at age 70 on your own. Or if the survivor benefit's higher, take your own at 62 and the survivor benefit at your full retirement age. You don't get those options as a spouse, but you do as a surviving spouse.
And that's a very big planning component that should be looked at by all families who unfortunately are in that position, and certainly advisors that are helping them.
Okay. John, let me add one other requirement also. And I don't think Jim said this. If he did, I do apologize. I might be daydreaming a little bit. But for a wife, let's assume she's the lower earner, for her to draw off the husband must be receiving a Social Security retirement or a disability benefit. So if he waits until age 70 to turn his benefits on, the wife won't receive a spousal benefit until he reaches age 70. So a big question is, does he turn his benefit on at his full retirement age to allow a spousal benefit to be paid then? Or does he wait to age 70? So that's a huge factor that needs to be looked at in determining when a husband and or wife should be filing for Social Security benefits.
Yeah, that's good call out, Mark. And Jim, you kind of touched on this in that answer, but this was also a question that has come in quite a bit. That what should widows know about coordinating their survivor benefit with their own retirement benefit?
Well, one thing that they want to do is they want to contact the Social Security Administration and get what's called a benefit matrix. This is a great tool. It's 1, maybe 2 pages. And what it'll do is it'll list your own benefit in one column at various ages from age 62 and 1 month, 3 months, 4 months, all the way up to age 70. So you'll see what your benefit is when you start your own retirement. And it'll in the other column, it'll show the survivor benefit. And it'll start at age 60, go up to your full retirement age. And that way you can compare the two. So what you need to know is there's a term out there called deemed filing. And what that means is you have to take your own benefit first and then any other benefit that you're eligible for. That does not apply to the survivor benefit. So what you want to look at is, what am I eligible for on my own? What could I receive as a surviving spouse? Which one's the higher of the two? I might want to save that one for later, because once that begins, I'll receive that higher benefit the rest of my life. But while I'm waiting until full retirement age or whenever I decide to file, in the meantime, I can draw this other benefit. It doesn't hurt when I switch over. If I take my own at 62 and the survivor at full retirement age, I still get 100% of that survivor benefit. The fact I took a reduced retirement benefit doesn't carry over. So you always want to take that into account, whether it's a deceased spouse or a deceased ex-spouse, if you were married to that person for 10 years or more before you got divorced. So all that needs to be factored in. That benefit matrix, the unfortunate part is it's not available online. You have to contact Social Security to get it, but it's a great tool to use. And for the people listening to this podcast, I would say make sure you contact John over that and give him that information. And then that way it's all coordinated and you can look at all the various options you have.
That's great wisdom there, Jim. And I appreciate you shedding that light, because that's, for someone that's in that situation and is unsure, that's a big planning component into their cash flow.
And it's huge in part. One small problem with this, I call it a small problem. The Social Security Administration sometimes is telling people, and this is normally through the 800 number, those people have the least amount of information about Social Security than anyone, it seems like. But they're telling people, nope, sorry, you have to take whichever one is higher. Well, that's not true. Wow. And it's right on. I always, when people ask me about that, well, how do I know that's you're right or they're right? I point them to the Social Security website, and it tells you on there that I'm right in that situation. So just because someone at Social Security says you can't take the lower benefit now and the higher survivor benefit or your own later, you don't have to believe that. That's why they want to talk to someone like you, that will help them go the right direction and get benefits that are due. I used to say that widows benefits, survivor benefits was one of the areas that Social Security did a great job on. And then I read an inspector general report that said a lot of people were losing a lot of money. So I'm real disappointed in that as a former employee of the agency. But it's real important people understand the benefits that they're eligible for and when they can take them.
John, just knowing those right questions to ask.
Yes.
That's the key, right? People don't know what's available if it's not marketed or they're not talking with someone that's knowledgeable like you all.
Right.
And let me add one thing about the service you may get at the Social Security office, or if you call the toll-free 800 number, which is 800-772-1213. They will take your application most of the time. They'll do it right. Sometimes they may make a mistake. People should not expect Social Security reps to provide any advice or guidance. All they're going to do is take your application. They'll answer your questions. Maybe they'll answer them right. Maybe they won't. Who knows for sure? But they're not going to provide you guidance. That's why there are advisors like yourself, John, that can really help folks across the country and your clients relating to the best way and the options that are best for them relating to Social Security benefits.
Now let's pivot for just a moment, maybe away from widowers and survivors to people who are divorced. And so if someone is divorced, what rules do they need to know about collecting potentially on an ex-spouse's benefit versus their own?
Well, let's have a little bit of fun. Let's assume I'm divorced. For my ex-wife to collect off my work record, she must be at least age 62. I must be receiving a Social Security benefit. It's either retirement or a disability benefit. So she must be 62. I must be receiving a benefit. We must be married for at least 10 continuous years. Jim, I don't think I'm missing anything on that one, am I? No. I just
you have to be single.
You have to be single. I knew I was missing one requirement. Yes. My wife must be single. I see. Ex-wife. We got 4 requirements. I only said 3. Anyway, okay. So she must be single. She must be at least age 62. I must be receiving a Social Security benefit, retirement or disability, and we must be married for at least 10 continuous years. Now, so the requirement that I be receiving a benefit can be kind of harsh. It kind of puts me in control. So there's another category of divorced spouses called independently entitled divorced spouse. As long as we've been divorced for at least 2 years, and both me and my ex-spouse are both at least age 62, she can claim off my work record even if I'm not receiving a Social Security benefit. So, divorced for less than 2 years, I must be receiving a benefit. Divorced for 2 years or longer, then that requirement goes away. And then the other question is, well, how do you find out what you can get off of your ex-spouse? Well, contact Social Security, and they're going to ask you to provide some information like a divorce decree, maybe a marriage certificate to prove 10 years of marriage. And they will tell you what you can get off of your ex-spouse. You also have to provide the ex-spouse information, name, first name, middle name, last name, and hopefully you'll have a Social Security number. This way they can tell you what you can collect off your ex-spouse. They won't tell your ex-spouse that you're looking into benefits off that person. That would be not a good thing to do, but they'll tell you what you can collect off your ex-spouse. You just need to contact SSA.
And Marc and Jim, is there a rule about, if you were married for at least 10 continuous years, and in order to even be eligible for this, even if you're single at 62, you cannot have remarried before the age of 60. Is that a true statement?
Jim?
No, you just have to be single at the time you apply. So if you remarry and that marriage ends for whatever reason, either another divorce or your spouse passed away, now you're single again and you can be eligible. And now if you're married to 10 years to both of your exes or all three of your exes, then you're eligible off of whichever record will pay you the higher benefit. So you've got some choices there. What you're thinking about or talking about there, the age 60 rule, that's in the case where you have a deceased ex-spouse. And technically, you're supposed to be single to draw off of a deceased ex-spouse, or even a spouse that you were married to that passed away. You're supposed to be single. But if you remarry after you attain age 60, Social Security will disregard that marriage and pay you either the widow's benefits or the surviving divorced spouse benefit. So the age 60 rule applies in that case, but not to if you're drawing ex-spousal benefits, you remarry, those benefits terminate. But your question was, they'll start back up again once they get a new divorce. Yeah, I'm sorry. So
No, I was just saying which is kind of goes back to how important it is of, when people come to us and talk about, well, I was talking with my friend about this, or I read it online. It just goes back to what you all said at the beginning of the podcast, how important it is to truly know what is applicable to you and ultimately what is not. In this case, divorce versus survivor. And so, guys, let's maybe talk about kind of going back to kind of the broad audience base. Out of all of your two's experience dealing with this, what's maybe one of the biggest mistakes you've seen retirees make when it comes to their Social Security benefit?
Well, let me state one thing. They listen to their neighbors. One neighbor may say, well, they collected off a spouse, or they collected 62, or they wait until age 70. Well, that may not be appropriate for you. You and your family situation in that case, maybe it's better for you to collect at your full retirement age. Maybe it's for you to collect at 62 or whatever. Don't listen to your spouse. No, I didn't mean to say that. Don't listen to your neighbor. Don't listen to your friends. It's like getting stock tips at a New Year's Eve party. Those stock tips only work for the person that's giving it to you, not for the person that's receiving it. You know what I mean? So don't take advice and don't follow the strategies of what other people tell you might be best for you.
That's great. And so, you all had kind of mentioned this as far as SSA.gov, but for all of our listeners out there who are wanting to really maximize their Social Security benefit, would you say that first good action step is to create their account online?
Yeah, absolutely. SSA.gov is a great website. Just make sure it's .gov because that guarantees that you're in the Social Security government website. But there's a lot of good information on there. You have access to all kinds of pamphlets that they have about different topics on Social Security. If you're disabled and want to work, if you want to take your benefits early with retirement, spousal benefits, it's just all sorts of publications that are out there for people to look at. They have blogs that you can read that talk about Social Security. So it's a great website. I really like the SSA.gov website. And that's where you go to create that online account and then to sign up or to get into it after you have created it. So I would suggest that you start off by going there, and if nothing else, just looking around, start poking around, looking at different things that are on there, the services that they offer. And it's a great way to get started.
Yeah, John, I think 97 million folks have online accounts.
Wow.
Now, the number of people with online accounts differs with what you might be reading. For example, the current commissioner of the Social Security Administration wrote an open letter about 3 weeks ago. He said there were 75 million online accounts. Then I received a blog from the Social Security Administration, because I get blogs all the time, and the blog indicated 97 million online accounts. So Who really knows who to believe, the commissioner of SSA or maybe their public relations person? I think the right figure is probably closer to 97 million. Because I think over about 200 million people have paid into Social Security. Not receiving benefits, of course, but have paid in. So 97 million kind of seems reasonable in my mind.
Yeah, and I, like you said, it's a great website. It's a great way to go in, and certainly I think, Jim, like you'd mentioned, just ensure that the earnings that are being reported of what you've earned year over year in your career, look to be accurate and not misstated, which will throw off your benefit. And so, Jim and Marc, thank you so much for coming on the podcast. Is there anything you'd like to leave our listeners with?
Yeah, my comment would be make sure you plan for Social Security. Don't just assume you should start at 62. You may be receiving benefits for 10, 20, or maybe even 30 years. My dad received benefits for 27 years when he passed away at the age of 92. So make sure you plan for your Social Security benefits.
Yeah, a few years back, Marc coined the term situational Social Security, and we like that because everyone's situation is different. As he mentioned before, just because your neighbor did it one way doesn't mean you should do it that way. There's all sorts of things that will factor in. And so do a little bit of research, do some planning before you apply. It's always easier than it is if you have to correct stuff. It takes forever. Keep in mind, too, that the Social Security Administration is going through what everybody else is going through. And so they're not hiring people. It's taking longer and longer to get things done. And I was talking to someone just this past week, and they're just real frustrated with the amount of work that's coming in, and nobody's there that can do it. So plan and file in advance so that you have everything set up and ready to go and you don't have to wait. But it's an important benefit for a lot of people, and it will be there in some form or another. Congress is going to have to make some changes, but I'm sure they will. And plan as if you're going to receive your benefits and take it from there.
That's great parting wisdom, guys. And thank you both again so much for coming on and tackling what's probably one of the most asked topics that we try to assist our families with, and really appreciate you all coming on. And we're looking forward to the next episode. Thank you all very much.
Thank you, John. Thanks for the opportunity.
Yes, thanks. Appreciate it.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Olympus Wealth Strategies or Uptick Partners, a registered investment advisor. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions. The investments discussed on this podcast may not be suitable for all investors and involve risks that should be carefully considered. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Certain investments may require specific investor qualifications, which not all individuals may meet. Any funds or companies discussed are not a recommendation or endorsement. Guests in the podcast might be actual clients, but are not compensated to be on the show, and their experiences are not representative of all relationships, which might differ substantially.